Hi, good evening. 1st of December 2024, and we are going to talk about portfolios. I'm not going to give any prediction on markets because I'm ill equipped to do so, and neither I have any intent of predicting the markets. Eventually, it leads us nowhere, but yes, it is something that a lot of people in the market want to know. So that be it. Why basically we do not want to predict markets is because we want to concentrate mainly on the strategy of the portfolio. So we have seen some normalization. We've seen Nifty correct by almost about 8.5% from the top, but few stocks have seen higher correction. Few mutual fund schemes have seen higher correction. So what does one do from here? Obviously, just a disclaimer that this is not an advisory call or an advisory video. I'm just sharing my own experience of what I feel one should do. One is better advised to take opinion from their own advisors or their portfolio guardians, as I would love to call them. So I feel is that asset allocation will come triumphs again. We will see that people at various points of time want to take higher risk for higher returns, but eventually what boils down to the fact is what is your long-term portfolio return. I'll explain with an example. Now suppose you are driving from Delhi to say Chandigarh, and you have a big latest SUV, great horsepower. You start driving. Once you cross Delhi, you pick up a speed and you run at say about 100 kilometers per hour. Great speed, 120. And you drive all the way to Panipat at a great speed. Now, once you reach Panipat, you find there is a traffic jam and the traffic slows down up till Karnal, and thereafter you only get an average speed of about say 70 kilometers per hour. You reach the Chandigarh, you just press that little knob, or if it is a digital display, you just check what has been your average speed since you started from Delhi. 95% people will be between 60 to 70 kilometers per hour. And despite the fact whether they were driving a mid-range SUV or a sedan or a big SUV or a sports car, the averages don't change. And that is what stock markets are. So at certain points of time, you have the opportunity of driving at high speeds, which we have seen in the last 2 years. Then you could have years where you are stuck in traffic jam, or markets don't move or they correct, and eventually they pick back. So what matters at the end of the day is what is the average return you want. Now, somebody met me and said that, okay, I started investing in 2021. My average return is 25%. Great return. So where the expectations now are 18 to 20%. That is where people get it wrong. 18 to 20% is an aberration. I'll tell you why. I'm sure people can make such kind of returns, but I'm talking about larger public on an average will not be able to achieve higher returns when the markets itself or the economy itself doesn't have the probability to do so. And how I measure it is like you take inflation number, which obviously is a printed number, so there is no two debates about it where is the number coming from. Similarly is with the GDP. You add GDP to the inflation, you get the nominal growth rate of an economy, and I presume that is the rate at which you should expect your money to grow if you invest in equities. Obviously you take another 1 or 2% for the outperformance that a fund manager can produce. That should be a base case return. Obviously, if a fund manager is much more wiser and intelligent, he can maybe grow that alpha to 3 to 4%. And this is large cap. When you talk about a mid cap, you take the similar index. So when you take mid caps, you add another 2%. You take small caps, you add another 2%. So if anybody tells me that he's going to put all the money into mid and small caps, no large caps, then obviously they can expect that kind of a number. But on an average, when we say about we are doing portfolio allocation towards equity and then to debt, let's talk about what can equity deliver. So let's assume a GDP average growth rate of 7%, and inflation of about say 5.5, 6, let's say 6%. So this is about 13. Maybe add another 1 or 2% by fund outperformance. So your base expectation should be 15% minus the tax you have to pay, because now there are long term, short term, both taxes apply. And purposely we are talking about long term here. So let's assume post tax you're making about 13.5%. So if you come in the markets with that expectation, I think everybody will be pleasantly surprised over the long term by the upside of the return. But if you come with 18%, I think at certain point of time when the markets don't run as per your expectation, you are bound to react. And in investment, inactivity sometimes becomes the biggest activity. For that, the precursor is setting your expectations right. And that is my whole point today. So a lot of people in the market, when there is a bull rally going on, try to test various products, various risks. So people go to unlisted shares, people go to AIFs, people go to PMS. None of them are a bad product. It is about suitability. It is about all of your portfolio strategy and how much risk can you absorb. So if you're a person who say that, okay, I've invested 100 rupees and I don't mind at a certain point of time, even if 100 looks like 60, 70 rupees, I will not sell. Maybe I will add more and I will be persistent because I'm here for the next 10 years, 20 years kind of thing. Now, if you're that kind of investor, you don't need to worry. Keep adding on every fall that you get. We have a great story for in Indian economy, and I hope and I believe that the stock markets will mirror that economic performance in share prices as well. But if you are here for say 3 years and you have some objective, you want to maybe buy a house in 3 years, send your kids to foreign education, or maybe you have some other financial goal and you think that you can just invest, make money, put it in some IPO in a company where you don't even know whether the business will sustain or not. And then later on, if the market's correct, then you cry foul that the stock market is all mismanaged or managed by few promoters or XYZ. That is because you didn't do the homework at the first place. That's why it is very, very important we lay down our objectives of the money. It is not important that we earn the highest return in the market. But what is more important is that our goals are met through the strategy we adopt. And I think first, the goal should define the strategy should not define goal. So suppose I have to build a house in 7 years, I have to construct my portfolio in a manner that after 5 years, I shift that money into a safer option so that I don't face any last moment volatility and lose my capital. So that basically boils down to the fact that how does one avoid himself or herself from a lot of information that comes through every day, a lot of opportunities being discussed. So therefore, it is very, very important. Each of us should write an investment policy statement of our money. Now, what does an investment policy statement do, or what it is? So it is basically a note, maybe, you can put it in your Microsoft Word document or on your computer anywhere. That first is, what do you want from the money? Second is, if you want, whatever you want, at what percentage return can you achieve it in the time frame you have? Now, if it is beyond the realms of possibilities, you have to adjust your goals. You cannot tell the market to deliver you more returns just because you have higher goals. So for example, I might want to buy a 5 crore apartment in maybe next 10 years. And I have say 5 lakh rupees in my account. How on earth is going to 5 lakhs turn to 5 crores? So somebody comes and tell you, okay, sir, you can play in futures and options and you will be able to reach there. That is where people go wrong, because then you are pulled by greed and you're wanting the market to adjust to your goal. Don't do that, please. So let's build up possibilities of returns. Say equity is 15%, say fixed income you take 6%, gold you may take 7%, real estate you may take 10 to 12%. And now decide, if you were to put say X amount in real estate and Y amount in equities, where will you reach at the average returns they have delivered in the past, say, 2 decades, and put a caveat to it that you can go wrong maybe 30-40% also. So what do? One is obviously we have to go by history. We don't know the future, but history has taught us that even with 50, so I'll give you an example. Even with 50% portfolios, people have attained the return which 100% equity gave, because what we concentrate on is the risk adjusted return. And mind you that it is not just plain vanilla numbers that work, it is your behavior. So sometimes if you are not prepared for a fall and the market falls down, there is a tendency to move away. You may sell at the wrong time, sell at a lower price, and then never come back. So therefore it is very, very important we do all the basics right. We define goals, investment policy statement has goals upfront, then we decide the path, and then we build up a insurance mechanism, which is what if. So what if you will not wake up at the end of the 10th year and decide what to do, because you are going to monitor the portfolio maybe minimum 2 times a year. I also am against frequent monitoring because that leads to action, and inactivity is a very, very strong habit to form in investing. So goals, path, risk appetite, and various other things. So everything you think about money should be that there in your investment policy statement. Now, I don't want to stretch it too far, so I'm here to help people write their own investment policy statement. If they want to do it on their own, they can find it various what you call samples are available on the internet. But keep in mind that you have to have somebody who has to take decisions away from your biases. So that means your behavior should not come in between the managing the portfolio strategy. So that's it. I think my whole idea today was to bring in the sanctity of asset allocation, sanctity of portfolio strategy, and the importance of writing an investment policy statement. I'll be coming up with a new video soon, and if you have any questions, you can just comment on the video, or those who know me can just get in touch. Thank you, and have a wonderful December and winters ahead. Take care.